Welcome to Small Talk Podcast. This is Taxed and Relaxed with Rachael from Chadwick Accountants.
Welcome to episode 21
I know.
of Taxed and Relaxed.
Brilliant.
I know. I'm Rachael Chadwick Harrison from Chadwick Accountants, your host.
And I'm Natalie from Small Talk Podcast, the producer.
Wonderful. Today we are going to be talking about funding options, how to fund your business, the different kind of funding that's out there, and most importantly, tackling that jargon. So let's dive right in and let's talk about bootstrapping.
Sounds painful.
It's not, well, I suppose it could be, yes. It's a term used a lot, and a lot of people don't actually know what it means. Natalie, as a business owner, do you know what bootstrapping is?
I really don't. As I say, it sounds painful.
So actually, bootstrapping is funding your business using your personal savings or reinvesting the profits that you've made.
Okay.
Yeah. I'm not sure where that comes from. Maybe we should have looked that up. But
That is, yeah, I guess
it's like making tighter, so your own personal finances are tighter because you're putting in your business. Maybe that's just an idea. So the pros of that is that you remain in complete control over the decisions you're making in your business. You're not giving away any equity, etc. You've got no repayment obligations or interest costs. Well, you can charge interest to your own business. That's another conversation, but it's only going back in your own pocket. So, and generally, you'll pay it back when you have the money to. Obviously, the cons, you may have a limited amount of capital, so that could slow your growth if you need more. And obviously, there's a massive increased personal financial risk. If that business goes under, that's all your savings gone as well. Yeah. And, you could have those savings to, save for a child's wedding or your own wedding, a special holiday, maybe even, a house if you've not bought one. So depending on your financial situation, it might not be best to use that if you have something that's really essential that you need there. I know personally when I set up my business, I used my personal finances to do that. I did bootstrapping. I sold my car to do it effectively. My mentality was that we have the house, we had one nice car. I sold mine and got a really cheap 15-year-old Fiesta. And that was money I could afford to lose. So my advice would be, if you can't afford to lose it, don't invest it. Don't do bootstrapping. If you can and you're willing to lose it, yes. Great way to fund your business.
It's a risk, isn't it? But yeah.
So next on the list is traditional bank loans, and it's where most businesses go, to be fair. So this is borrowing money from a bank. It's based on your creditworthiness and sometimes collateral as well. And what we mean by that is it could be secured. Now, if you're borrowing from a limited business, a lot of them, especially if it's the first time you're borrowing or your business is fairly new, they're going to ask for something called a personal guarantee or a director's guarantee. What that means is that your limited liability business that you set up is no longer limited liability.
No.
Your personal assets are on the line for this, which is an acceptable form of borrowing if you need to borrow. And my advice would be to only do that if you feel it's low risk borrowing. Perhaps you're buying equipment that has a resale value, that if everything went pot, that you'd get enough back to pay the loan off, etc. That would make good sense. But actually, it's really difficult to get a traditional bank loan.
It really is. Even with a good credit score, these days, this climate, it's very hard.
Especially for new businesses. It's really considered high risk because of so many new businesses going under within the first 5 years that most banks are asking for personal guarantees. They may also ask for what is called a debenture. Now, what this is, it's a formal document. It will sit on Companies House for everyone to see. It's very common when you're buying a property, where the bank puts the debenture on your business that says, if you go under, we get our money before anybody else does.
Ah, okay. First, the beginning of the queue.
Beginning of the queue. That's a good way of putting it, yes. So that's what they might ask for. So your pros of a bank loan are it's a nice structured repayment terms, usually the interest rate isn't too bad. You'll retain full ownership of your business and control. Cons, there is a really rigorous approval process. Sometimes there can be collateral requirements, those personal guarantees. Often they'll be asking for business plans. You might have to pay advisors to help you make them. They'll ask for a lot of financial information. They'll want your management accounts up to date. They'll want bank statements. It's not a quick and easy process by any means. Your fixed repayments can strain your cash flow during lean periods, so it's not obviously as flexible as bootstrapping, but it's a good option for many. What I would recommend is look at the British Business Bank. Regardless of which bank you are with, we've found a lot of traditional high street lenders are just not lending in business. But if you go look at the British Business Bank, they are absolutely fantastic. They're really good. They offer a lot of support in building a business plan and general business advice, but their rates are really quite low and they do a lot of work with new businesses.
Oh gosh, I've heard of them.
Yes, I would.
Are they quite new, or they've been going for a long time, or I don't know. I've actually genuinely not heard of them.
Well, yes, they are actually fairly new. They only started operating in 2014, so we're talking 10, 11 years now.
Yes.
And they actually they were set up to drive a net zero economy, and they really want to improve finance for smaller businesses. So if you're a small entrepreneur, or a new business, they are the place to start.
Okay.
Your traditional banks are not really interested in startups. They're really not.
No.
So let's look at angel investors.
Oh,
Everyone's heard of
We've
that.
all heard of them. Yes.
Yes. So what do you think that is, Natalie?
They are. I think they're other businesses, are they, that are willing to help support and invest, or organisations that specifically work with startups?
Not
Am I
quite.
right? No?
Not quite.
Okay.
So Dragon's Den?
Yes, it does spring to mind. Actually,
that's angel investors.
Oh, okay.
So they'll invest. They'll want a good chunk of your business, but they'll give you the mentorship and help make sure that they get their return on investment.
That's a quite old-fashioned way of looking at it. It's good though. It's
yes,
very good. Yeah.
It can be great if you want to scale.
Yes.
Not ideal for a small company whose ambition is just to make a life for themselves. No,
Right.
It's more those who want that rapid growth.
Expand.
Yes.
Okay.
So the pros of that is you can get some access to some really valuable expertise and networks. There's often flexible investment terms. Often you're not repaying the money. You're just giving them some of your equity. And that real potential for that strategic guidance to really get you where you want to go. Make sure you pick someone that's right for your business.
Yes.
If you decided that you're going to set up an amazing, home baking bread business or something, you don't want somebody whose experience is all in a completely different industry, in utilities. It's not really,
No.
You need someone with similar experience that's really going to add value to your business. The cons is you're going to be equity dilution, you're going to lose some of your business, but
Control.
but what I would say is 100% of a small pie, actually 50% or whatever percentage of a much larger pie
is worth it. Yes.
It's better.
Yes,
yeah.
indeed. Yeah.
You got to think what's better for you. You're going to have shared decision making. So you, depending on how much you give up, you may not have the final say anymore. If you give over 50%, you may have an agreement where they own 20%, but they have to agree to everything. Depending on how that setup is. So that's something to consider. The investors may demand high returns and influence your business direction. So it sometimes can feel a bit like you set up this business, you were really enjoying it, you had a good work balance, but now you're on the hamster wheel and you're running because you've got to deliver. Yeah. So have really clear expectations when you go into this. What does your investor expect? And, what kind of hours you're going to have to put in to deliver that.
Yeah.
Are you on the same page?
Yes.
Yeah.
And do you get on with them?
Yes.
Personalities have got to be really important.
What a great point. You've got to work with that person.
You've really got to.
Oh, you certainly need to have some rapport there. That is.
It might not be an angel. That might be,
you need to know who you're getting into bed with. What I would say is often an angel investor will be someone with a personal connection to you. So it could be a mother, a brother, an auntie, who invests in you, be really careful of that. It's really important to have a contract in place. If you know that person, there's a personal connection, a friend, family member, have a contract in place on what the agreement is. Is the investor expecting their money back by a certain point? Are they expecting to, what are they expecting exactly? Because in so many situations you see, oh yes, well, my brother's decided to lend me 50 grand to do this. And then a year later, my brother wants his 50 grand back. Oh, that was never agreed.
No.
Have a contract.
Yes.
It doesn't even have to be with a solicitor. Just have something that you write out between yourselves and have a witness it. Ask around. There are plenty of companies online that will do you a contract.
It'd be too close to home if you fell out with somebody in your family. That would be awful.
But if you have the contract, it protects everybody involved.
Of course it does.
It makes good sense.
It does.
Now, the next one is actually what you thought an angel investor was. Venture capitalists.
That's what I was thinking.
Yes, there's where these companies come, they'll put massive amounts of capital, cash, in your business in exchange for substantial equity stakes.
And how do you find these people? Are they online? I guess they would be.
That's a very good question. So when it comes to venture capitalists, there's often specialist middleman firms. Right. So they will put you in, they'll help you get together an investment pack which showcases your business, how much capital you're looking for, your projections, what you're going to do with that capital, the return they can expect to make. And then they'll set up loads of meetings with lots of different people, and you will come out of that with maybe one or two that you want to have further conversations with. Because like you said, being able to work with them, most important thing. Because you might want to, a lot of venture capitalists can be quite, I want to say silent, not officially silent, but they don't have much to do in the day-to-day like an angel investor might do.
Right.
So they'll want to come to a monthly board meeting. You may find some of the things you did informally now become more formal, more rigorous.
Maybe?
Yes, corporate. Yeah, definitely. Yeah. Where you now have to do specific financials every month, and you have to change some of your processes in order to adapt to that.
Which is fair enough.
Yes, but if you want to rapidly grow, venture capital can be a really great option. So the pros of that, often they'll put a large amount of capital in to fuel some rapid growth. So they will just put in whatever you asked for.
Right.
Yeah. A lot of them have, they're investing in several businesses and maybe hundreds of businesses. So they have a great network that can help with strategic support, may help build your sales, give you better supplier terms because they're using their network. The cons, significant dilution of your ownership, potential loss of control. A lot of these have clauses in them that if you don't hit targets, they take over. So you've got to watch that.
Yeah, definitely.
A lot of them do staged payouts. They'll buy a significant stake in your business, and you'll get a cash payout for that stake. But you might only get half of it now. Then you get half of it when you achieve X in 2 years or whatever it is. Okay. So you've really got to weigh up those pros and cons there. And finally, like your angel investor on the hamster wheel, like 10 times that, it's going to be real high pressure for rapid growth and returns with venture capitalists.
So it's quite harsh. It can be quite harsh, I guess. And then there's a personal liability. I guess if your company doesn't, again, you'd have to look at the contract, but if your company doesn't make up what they want it to, they might ask for, can they ask for their money back? So will they, if you don't achieve?
Okay, if you don't achieve. If you don't achieve, often it's the loss of control. Okay. So they may say that they take over all decision making.
Right.
And often when you go into these agreements, although you'll be a shareholder owner in your company,
yes,
they might be able to fire you from running the company or being a director. So you'd have to sit on the background doing nothing.
Yeah, so you could lose everything.
In a sense, you'd still have some shares, but if you have an agreement where you're paid out over a certain amount of time, the rest of those payouts are gone.
Right.
You've got what you've already had, but that's that.
You've got to be business savvy, haven't you? You've got to.
Yeah, you need to make sure that you can achieve what you agree to achieve, and that ideally it's not if I don't achieve, it's all over game. That there are some provision in there. If you have another COVID hit, that you're protected.
Yes.
Now, let's move on to crowdfunding. Now,
Ooh.
everybody knows about crowdfunding.
Yes.
Everyone's heard of crowdfunding. Most people have put a tenner on here or there for something. So it's raising really small amounts from a large number of people, often via online platforms. I think actually one of them is called crowdfunding. It's a really interesting way to raise capital. Some of the pros, it'll validate there's market demand for your product or service, builds a community of supporters who are going to want to buy your product. Often you crowdfund something because you want to buy it. It can be done with minimal equity loss if you use reward-based models. A lot of the time, crowdfunding is more set up as actually a loan repayment. There's very different. There's lots of different ways you can do it.
Different permutations.
Yes, but you can use crowdfunding as a loan, where you repay them. The interest rate is much higher. But if you have no access to anything else and you've got no personal funds, it's an option. Yeah. And those people are putting that money in knowing they are potentially going to lose it. Sometimes, if you say you're raising and you're going to create something, I think I saw one a while ago about making some special dice for people who played Dungeons and Dragons. They wanted to make some special dice and they were trying to raise some money. But what you were doing, you were advance purchasing those dice. Right. So they're raising the money they need to make everything.
Yes.
By taking your payment in advance, and then once they've reached their goal, they'll produce those, and you'll get your dice. It's a lovely way to do that.
It is, isn't it?
It is.
It's more maybe community based.
Yes, it creates a community.
It's
definitely.
quite nice. Yeah.
So the campaigns can be quite time intensive, and obviously there's an uncertain outcome. You might spend a lot of time and energy on it and not actually reach the goal and not get your payout. They all ask so many questions.
I found that actually, yes.
We've sat and done this for some clients, and like one person says, "Can I have a copy of this?" And then you get 5 other questions, and then someone else, "Can I ask a copy of the same thing again?" And because there's so many people, some are far more involved than others, and you have to answer their questions. It'll be, how many of your staff are male and female? And people ask loads of questions. There might be some platform fees, or there will be some platform fees, and there's going to be a need for some strong marketing efforts to get that information out to the public. Government grants and subsidies.
This is a tough one.
But if you can get them, they're gold dust. They're brilliant.
You've got one.
Yes, please do. Well, I've seen a handful of them. COVID accepted, because we saw plenty in COVID. Yes. But these are great because they're non-repayable. Oh, I love that. Non-repayable funds provided by government agencies and organisations for specific projects or sectors. Now, the most well-known one's got to be the Innovate grant.
Yeah.
If you're doing something in the innovative space, go there. But they are highly sought after. You can pay specialist companies to write your entries, and still there's no guarantee you're going to get one. You're in huge competition with others, but you might have far more luck with a local government agency one.
Yeah, so councils, etc.
Yes. Yeah. What are they doing in your area? And that's just change year in, year out. So have a look on their website. Just Google your council's name and business grants, see what's going on. So pros, no need to repay the funds, my favourite. Really enhances your business credibility and opens additional opportunities. So often the grants that I've applied for on behalf of clients, you often ask to perhaps give your time to other people in industry and help them, which is, I don't know, it's nice for the community bits and bobs, isn't it?
And raising your profile maybe as well.
Yeah, it really does though. If you've won an Innovate grant, you're going to shout about it because they're so competitive. The cons, highly competitive, which I've mentioned. Strict eligibility criteria, got to make sure you meet everything. Yes. Often tied to specific conditions or reporting requirements. Sometimes they require, being audited, and that's an extra cost that you need to factor in. Obviously they're given for a specific purpose. So if they say they're going to give you this to buy a particular piece of equipment, you can't then buy a different piece of equipment. You've got to buy exactly what you said you were going to buy.
Do they like to see receipts and things like that, I guess?
Sometimes. It depends on the grant. So some of the ones that I've dealt with, they've asked for receipts for things over a certain monetary value, not for others. Often it's staff time that they're paying for, so they might ask for copies of wage slips and things. Yeah. But it really depends on the government agency that you're using. So finally, alternative finance options. So these have lots of different names. So, they're called invoice financing, merchant cash advances, factoring. Basically, this is funding based on your future sales and revenue. And it provides quicker access to cash. As accountants, we hate it. It's a nightmare to account for, but it's quite popular. So, for example, if you sell a lot via Stripe, like people check out, they use Stripe to buy your product or service. You could borrow, and they're going to be assessing how much they're going to lend you based on your previous sales, because they've got all access to that. Okay. Say you borrow £5,000 and they're going to say, okay, we're going to take 20% of your sales till it's repaid. Okay. So real pro of that is that you're only going to pay when you're making sales.
You make money, yes.
Yeah.
Perfect.
I mean, obviously, there's going to be some clause that if you make no sales, you still have to repay it. So it's a real flexible option that can bridge some short-term cash flow gaps. Cons often come with much higher interest rates or fees compared to traditional loans. Obviously, it's a shorter repayment period. It could impact your cash flow if not managed carefully, but as long as you're preparing yourself that you're going to be paying X amount back, that's good.
That's good.
Just to sum up, there's a few things I wanted to quickly mention, is that with a lot of these funding options, there's some sort of due diligence that happens. You'll need financial projections, you'll need business plans, you'll have to negotiate terms. I do strongly recommend you get an accountant involved for those sort of things, especially if we're looking at large amounts of money. I do have some interesting stories to share about them. Which I'm going to very quickly mention.
It's a long one, this one. It's a good one, though.
Yeah.
Sorry, Kate.
I worked in mergers and acquisitions for a fair part of my career, and one cautionary tale I'm going to leave you with is where a company is bought out with and it's actually quite traditional in the accountancy sector, although this wasn't, but it is, where you buy, say, 50% up front, and you might have 20%, 25% 2 years later, final 25% 4 years later, so over a longer period, while you build up a successor who can take over everything you do.
Right.
And I've seen it happen where they've done this and they've got their 50% and then they've not worked well together. And they've been so stressed out that they've ended up leaving and they've effectively gifted their whole business for half the price because they've not had their other payouts.
Right.
And it's what you said earlier, Natalie, about having that personal relationship and how important it is.
Very much so.
So, Natalie, what emails have we got this week?
Oh, these are great. We've got Ari, who is running a cafe / bakery. It's a new business for her. She's asking if I need to expand my business. What are the risks of taking on debt financing, and what government grants or incentives are available for my industry?
Well, what a lovely question, Ari. Thank you. So risk of taking on debt financing would be if there's a personal guarantee. So if there's a personal guarantee, they could come after her personal assets, money in your personal bank, any property you own, any cars you own, whatever you've got. They can come after if you can't meet the repayments. If it's just on a limited business and and everything goes to pot, and there's no personal guarantee, then the risk is minimal to you, because if it goes under, they can't chase you for it. That's it. But if she's a small cafe bakery, it's just her, chances are they're going to want a personal guarantee. In terms of government grants and incentives, actually, I believe she's based in Solihull, isn't she?
She is.
There's actually a nice one on equipment grants. Anything from £2,500 up to £100,000 to buy equipment. But for our listeners, check your local council, check what grants are available, and see if there's anything you can benefit from, because you don't have to repay it, and we like that.
No. That's good. So there's a bit of a silver lining in the cloud.
Yes.
There somewhere. That's great. Okay.
And she might want a new oven or something.
Yeah.
Those big bakery ovens aren't cheap, are they?
No, they're not. And they're running costs as well, but I guess it's not running costs, but that might help her running costs. So, yeah. Okay, it's worth looking at then, isn't
Definitely.
it? That's great. Okay. So Casey, who's a social media trainer / consultant, asks, what role does my credit score play in securing funding? Can I improve this at all?
As a sole trader, it will go on your personal credit score.
Right.
That will be a big factor. You can improve it. You want to, register with someone like ClearScore, and they actually give you tailored improvements. So, whether that's reducing the amount of debt you've got on your credit cards, or even just sometimes it's as simple as consolidating 5 loans into one, can improve your credit score.
True.
So, making sure you're on the electro roll, but the specialist companies that are free, like ClearScore, that can help you improve that. Okay. And as somebody with a 1,000 credit rating,
we
I have plenty of experience in improving your credit score.
That's good, because it is a lot, isn't it?
It used to be in the 400s.
But that just shows you, if you've gone from that to where you are now, that's an incentive, isn't it?
It is, and it can be done. And all I did was follow the tips on ClearScore.
Ah, brilliant. And that's free, isn't it?
Free app. So yes, Casey, after you've improved your credit score, actually what the role that plays in is actually lower interest rates. So if you've got a poorer credit score, you might still be able to credit, but the interest rate's often much higher. So it'll save you a lot more money having a better credit score.
That's really good advice. And a lot of people don't look at their credit score. They don't realise until they want to get a loan or something.
Or a mortgage. And realise they can't.
Yeah. And building it takes time. So you've just got to really plan it. Again, it's about planning.
Planning ahead, being aware. And, plan... help your children, make them more aware. Yes. When they're 18, tell them, get a little credit card, put your fuel on it, pay it off every month in full, help them build a credit and get used to using credit cards, etc.
Brilliant. Okay, there you go then, Casey. Look at ClearScore. And that should get you on your way. So great. Okay, so Mark is an IT specialist who asks, how can strategic partnerships help secure funding? Is it worth me spending more time to build partnerships?
That's an interesting one. So Mark's an IT specialist. Again, sole trader?
I don't know. I think possibly. Yes.
Possibly. It depends, because it's a really difficult, very open question, isn't it?
Yes, it is.
So if we're talking about, becoming a partnership in a legal entity, that could help if the person you're partnering with has a good credit score. If they have a poor credit score, it's going to reflect negatively.
Of course.
If we're not talking about the legal entity of a partnership and just building good partnerships in business, it's really going to come down to financials and what they look like. So if that helps your financials look better, that's great. But other than building a strategic partnership with like a lender or an investor, there's not really got a massive value to you.
No. And do you think it's a solution he's thinking maybe is a good idea, but really you've got to really think about that and go down that road, because there's a lot of time you could waste getting a partnership together.
And I don't think they're going to be able to pull that many strings. No. But if you were looking more at the angel investor, then yes.
Oh, right.
Because if you knew someone who was really wealthy that could invest in your business, and that you want investment, and you can build relationship with them, then why not? But if you just know someone really good at the bank, probably not going to help so much.
It's not a good idea either. No, that's great.
So our next episode is actually going to be on credit control, how to improve your credit control, some really good automations we can look at. I'm really excited about it. It's a big part of every business.
Yeah, it is. And it's something we all need to consider at some point in our lives. So it's a good one to do, I think.
Definitely. So get those questions into me and I'll answer your concerns as best I can in the following episode. Once again, thank you so much for tuning into our next in the series of episodes of Taxed and Relaxed. Remember, taxes don't have to be something you dread. With the right preparation and knowledge, it can be a smooth and stress-free part of running your business. Just a reminder, if you have a business and you want to come on the podcast to enlighten our listeners, if you've got something you think they will be interested in, do get in touch. Be sure to follow me on Spotify, Apple, Amazon and YouTube.
Indeed.
Taxed and Relaxed, so you don't miss any of our upcoming episodes. And you can follow me on social media, mainly LinkedIn. Otherwise, you'll get my team on Instagram and Facebook. They can give you more information about what podcasts are coming up and also our services that we provide. Get involved by emailing me with your questions to podcast@chadwickaccountants.co.uk, and I will do my best to answer them week by week. Until next time, put the kettle on, relax, and remember, you've got this.
You have been listening to Taxed and Relaxed, a small talk podcast production.